Hello and welcome to MF Corner. I'm Sonal Putra. With me as always is Vinny Motiwala. And in today's Mutual Fund Corner, we'll focus on investing in mutual funds for the long term. How do you stay invested, especially in a volatile environment? To understand the ideal holding period, common mistakes one should avoid and more, we have with us Kinjal Desai, who's the fund manager at Nippon India Mutual Fund, joining us now. Hey, Vinny.
Hi Sonal, good afternoon, and Kinjal, good afternoon to you as well. So today obviously Sonal explained the topic that we're discussing as well. Let's start by discussing the basics. For investors with a 10 to 15 year horizon, how should they think about equity allocation in today's valuation environment? What should they be looking at? Kinjal.
So the way that I would look at it is that from the last 20 odd months, so we've seen that the equity markets have largely moved sideways. With earnings growth in several sectors have come to about 8 to 10%. Some of that excess valuation does seem to be gradually getting corrected. What I would kind of see is that long-term investors should use the next 6 to 12 odd months to build or increase their equity allocations. And India is still in very early stages of its growth cycle, with several of the emerging sectors are yet to scale up. There are multiple opportunities which will get created for investors who have, that kind of a longer time horizon thought process.
Okay. Kinjal, we are speaking to you at a time when there's so much happening, and at these times, investors look out for sane voices as to what to do when we are seeing these sharper drawdowns and there's so much uncertainty. So how do you balance staying invested for the long term? There is tactical rebalancing that we are looking at as well. We are looking at markets seeing lower lows every day. So what would your advice be to investors at this point in time?
So, while definitely there is a lot of external noise which is taking place, no doubts about it. But what normally ends up happening is that investors, the problems arise when investors are trying to chase for the fear of missing out. In these times, having a very disciplined asset allocation approach, especially with periodic rebalancing every 1 to 2 years, depends on the valuation. Depending on how the valuations are panning out, definitely help manage this kind of risks that are taking place. Just as an example, we have seen, over the last 2-3 years, the kind of rally in precious metals. So that would have really supported a portfolio which had some, asset allocation on those lines. And that kind of helps you balance, whatever rough weather that comes along the way.
Kinjal, over a period of time, or what is the data indicating in terms of the ideal holding period, that actually truly benefits from equity mutual funds in India? Is there anything on those sorts of a line and data point?
So the way we think about this is that India has a very strong secular growth story, and we are a relatively very young structure of economy. So having a 10 to 20 year kind of investment horizon works best for us. There will definitely be cycles along the ways, but broadly one can kind of think that returns over time will broadly follow the underlying economic opportunities and the growth potential of the country. Our per capita still is just at around $3,000, and we are in very early stages. So there is a definitely much longer runway for growth.
Okay, there is runway for growth. Of course, we're seeing these short-term blips and just trying to understand the secular story when it comes to domestic investing as well. But when we talk about long-term portfolios, how important is fund selection versus asset allocation in driving returns? Because this is something which can get very tricky at times.
So asset allocation is absolutely paramount to achieve one's goals. There is no two ways about that. However, fund selection, especially when you have strong fund manager track records, can definitely help increase the probability of better outcomes of wealth creation over a period of time. But at no point can asset allocation be the second in line in your thought process.
Asset allocation is key. It cannot be second in line to your thought process. That's a very key important takeaway there, Kinjal. Kinjal, to SIP investors maybe who, there are so many ups and downs in the market. So who actually survive through those downturns, do they actually meaningfully outperform? Or those who pause, is there something of a difference in terms of the returns there?
So SIPs are actually created for the downturns. Right? You technically get more units per rupee invested during these times, which definitely help the better long-term compounding effect, on the portfolio. It's like in any other activity, you get better quality at better valuations during these times. So staying invested during the downturn, especially in SIPs, and if possible to top up during that time, really helps over a period of time.
Okay, and that's where the behavioral investing part of your investment thesis works, right? When you are patient and calm during these downturns. So say over a 15 to 20 year period, what are the biggest behavioral mistakes that erode compounding, and how should investors avoid them, Kinjal?
So 2-3 things come to mind out here. First is most people tend to fear volatility, but actually that can be your friend when it comes to improving these long-term returns. So that's it kind of ties in with the SIP thing that we talked about before. Another point which comes to mind is that being extremely disciplined in your investment approach, that one can define it either through time horizon or goal-based investing, whatever helps you. But this particular discipline does tend to help you remain invested through the cycles. Very often we see actually investors, they abandon asset allocation, right? Because of the fear of missing out. And that is when it is needed the most. And that does tend to hurt long-term compounding as well. And lastly is every investor needs to have a very clear individual financial plan, as it at the end of the day, definitely it depends on your risk appetite and your individual liquidity needs and how you are planning out, your future. So I think these are the 3-4 points which, does tend to kind of erode the compounding.
Okay. Kinjal, key points made over there, but thank you so much for joining us on the show this afternoon and explaining us in terms of details of investing in mutual funds for the long term and how do you actually stay invested, especially when the environment is so volatile. So thanks, Kinjal, for joining us. On that note, we're actually going to slip into a very short break. We'll come back with more on MF Corner. Stay tuned.